All right, super excited to get started today. Welcome everyone to the home ownership discovery class. Today is the first day of June. Really excited to get through May, had an incredible May, and excited to talk about this information that we have set for you. First, I want to introduce co-host Vincent DeRisi. Vinny and I worked together and been friends and family members for 10 plus years now. We have accomplished a ton of things together. I'm super proud of what Vinny has accomplished over the 10 years that we've been together here, working from loan officer assistant to processor to now one of the top producing loan officers actually in the entire nation. So wanted to pass over just a quick intro from Vinny before we get started here.
Wow, I don't know if I could top that intro. Well, thank you. Yes, it's been an honor working with family for 10 plus years, and it's just, it creates a better workplace, and everyone has the same goal to get people to get into home ownership. So it's really been a blast, and we're excited to do this class for everybody.
Awesome. Most days it's good.
Yes.
Most days. All right, so let's kind of jump into this. So first, want to make sure that we're mentioning we are honored and really just super excited to be a part of the Fox 19 team, and we have scheduled dates coming up this summer that we're going to be giving mortgage, real estate market, updates and advice. These are the dates. Those are going to be in the morning and in the afternoon time. There will be some additional dates as things progress, but Fox 19 is something that we've had the privilege to be on a handful of times already, and we're just kind of deepening the relationship going forward.
Yeah, it's a blast going on there, just giving out advice and what we feel like the Cincinnati market has to offer, and just trying to be a bigger outreach to our clients and our realtor referral partners.
Yeah, so if you're so inclined, check us on there, or if you have any friends or family, refer them over to those dates, and we'd love to catch up to you on those. All right, so first off the agenda, we're going to take a high-level approach at giving you some market updates, both here in Cincinnati and nationwide. We're going to talk about the pre-approval process. That's the super important, most important step of purchasing a house. We're going to talk about what this market is requiring when you're making an offer, and why our offers are actually getting accepted at a higher percentage than those of our competitors. We're going to talk briefly about what are the steps once you're in contract, kind of what your role is, and just kind of set a really nice expectation for the process. And then we're going to end with asking for you, the audience's help on some of these items. So speaking of the audience, I want to make sure that everybody is clear. We have on the call today, we have people that are pre-approved that are working with us. We've buyers that are on the fence, which that's a big category, right? There's a lot of folks out there that are like, I would like to buy a house. I have a house. There's something holding me back right now. So we have those. We have our real estate partners that we work with on a daily basis. We have investors that we work with. So there's a wider range of people that are on this call today. So we want to make sure that we are touching a lot of different basis points and making sure that we're driving home a few of the most important points on there. Okay. So first, let's talk about here locally. Cincinnati was in the news recently and got some really good accolades. So Cincinnati in the top 10 cities in America right now as far as where to live.
And it kind of loops it into investors and with even home buyers, because it just gains additional equity. It brings in more value to that property, because Cincinnati is such a desired area to be wanting to live in, just with places to go and places to do, things to do. It just makes it so desirable, especially from the coast, like you talk about all the time. The coasts are starting to come into Ohio and see, wow, the value is great, and there's just so many so many great things to do, kind of like what I'm trying to bring up over here. This morning, Fox 19 also ranked that Cincinnati was one of the top staycation places as well,
I saw that.
which I think also builds onto the value of home buying in Cincinnati.
Yeah, so definitely for the folks that are married with kids, staycations, that's huge. You know, in myself, I did not grow up in Cincinnati. Grew up an hour and a half north of here. Vinny is not from Cincinnati. In UC, you know, we're here for life, right? So just kind of proving that point. So, all right, now getting more into what is going on with the current market. You know, we're going to talk about inflation because inflation is the number one driver of interest rates. Okay, so inflation in the inflation numbers that you're seeing and you hear in the media, that's an important factor to really pay attention to, because as that inflation number goes down, you're going to see interest rates follow that. Okay, that has been the number one indicator of interest rates. But on this graph, you're going to see, you know, what happens with rent. So if you're talking about home ownership, you also have to talk about the opposite of home ownership, which is renting. And what historically happens, especially in a case of high inflation times like we're in right now, the rents are going to increase. It makes sense, right? Your milk cost goes up, your eggs cost goes up, your gas goes up, rent's going to go up as well.
Well, and that's just the name of the game, unfortunately, where an investor, a landlord, their cost of goods are going up, and the way that they want to make up for these costs of goods is they're going to pass it on to the tenant. And it also goes on in between with that supply and demand as well. It's kind of plays into factor with real estate as well. But in this case scenario, inflation is definitely a big key where we see rates going, and hopefully it starts to settle down and we'll level out.
Yeah, absolutely. So one of the biggest questions that I've been asked, being the elder statement.
Well said.
Yeah, is, you know, I've been doing mortgages for 22 years. You know, have been through the 2008 housing crisis, and when people see prices increase the way they have over the last 3 or 4 years, that's obviously no secret. You know, home prices have gone up quite a bit, and they try to relate that to the 2007, 8, 9 housing crisis. What happened there? You know, house prices increased at a very similar, similar percentage over that short period of time, and then, you know, something happened and it actually crashed. So there's a lot of similarities between there, and that's where the similarities stop. Okay. One of the key factors to keep in mind is right now, and this is what the graph shows, is that the lending regulations that are set forth on home loans now have produced some of the highest rated loans. As far as, you know, we look at them based on foreclosure, missed payments, all of the factors of where basically the homeowner can't make the payments on the property and the loan goes bad. So based on those factors, these are the best loans that are out there right now, and America as a whole has the highest percentage of equity in their home. So the number one factor in 2008 why people walked away from their mortgages is because most of them didn't put any money down in the first place to own the property. So there's other factors that went into it, but you know, the big thing is I can spend literally 4 hours talking about this, but 2008 and now, 2 different time periods.
Correct, and I'll add to that where the type of buyers that are winning the deals right now, that are buying, are so strong. It just coexists with the Cincinnati market and nationwide in comparison. You know, a conventional buyer putting 5-10% down is going to win that deal over, unfortunately, someone who's trying to do an FHA 3.5%.
Sure.
Not that may be a better person, but it's just, unfortunately, a conventional loan is a stronger type of a loan, and that's what we're seeing in the nation and in the Cincinnati area right now. I also read a stat, I'm sure you could fact check me on this. The loan to value, basically what that means is what the house is worth compared to what homeowners own right now are at an all-time high as well. So the equity that our home buyers have going into years to come has never been higher.
Yeah, absolutely. It's two factors. You touched on it before. Conventional loans have primarily been the loans that have been accepted by sellers. So what we mean by that is when a buyer is making an offer on a house, the pre-approval letter, the offer states that they're going to be using conventional loan to purchase the house versus FHA. Okay, so conventional usually requires a little bit more money down. So as a whole, the closings have had the buyers bring in bigger down payment. Plus, on top of that, homes have appreciated. We've got more equity as a nation, more equity than we've ever had in the past. Okay.
And simply put, I mean, you could vouch for this too. It's just it's there's a lot of documentation to get to buy a house nowadays. There's a lot of vetting that goes on, right? We have to make sure that everything lines up where, 15, 20, 30 years ago, there wasn't that regulation to make sure that it was eligible buyer buying. So it's definitely night and day compared to 2009, 2008 to today.
Yeah, absolutely. So, that the reason that we're touching on that so importantly is with the home prices we see go up, the question is, are they going to go down, right? Are they going to continue upon the same kind of trajectory that they're on right now? Are you, the buyer that is interested in purchasing right now, are you making a good choice? Are you making a good investment? The answer is yes. Okay, and the key factor here is to determine the direction that a home price is going to go. We go back to our 7th grade economics class, and it's just supply and demand. Right now, there are the same amount of buyers that there are amount of houses that are for sale. So what that means is in the Cincinnati local area, there's about 1,000 houses that go on the market every 30 days. And of those 1,000 houses, there's about 1,000 transactions that are closed in that same amount of time. So what that means is we have 1 month, okay? So exactly 1 for 1 over 30 days, 1 for 1 on new listings and contracts, okay? So that 1 month of inventory means that it is a seller's market. 1 through 6 is a seller's market, as you can see on this. 6 and 7 is a neutral, and then above 7, you're going to get more into a buyer's market where you're going to see more houses on the market, houses staying on the market for a long time. You're driving through neighborhoods, you're going to see the for sale signs up a little bit longer, things along those lines, things that we haven't really seen in 5 plus 9 years. And so it's really important to understand that not only are we in a seller's market, but how deeply we're in a seller's market, because the key factor is this: have you spoke to someone that said, hey, I'm going to wait until it's the buyer's market so I can negotiate a little differently, I can get a great deal? We're really a long way away from that. So it's important to understand that we're really far away from that. And on top of that, the house that you're going to purchase, the price that you're going to pay for it now, the expectation is that that price is going to go up and up and up, because we have so far to get to the buyer's market where the prices will even out as well. Okay. Anything to add on that?
Cost of waiting sometimes is costly, and year after year, housing typically appreciates anywhere between 2 to 3%. The past few years, we've seen some crazy numbers, and they're starting to level off quite a little bit depending on the area. But like Chad mentioned, we're still in that seller's market where that supply is not as high for our demand, and it's still driving up prices quite a little bit over that asking price. So that's why it's always important to make sure that you do know your numbers and make sure that you are touching base with us during that process of looking at the houses.
Yeah. So now we're into a really interesting time. Okay, so we're talking about how many buyers are actually in the market, how many houses are in the market to sell. Those are the sellers, and are those sellers going to be buyers? Okay, so it's all interwoven. And then of course we have our interest rates. Why are interest rates so important? Okay, so an interest rate is going to be the driving force for a lot of our buyers that are going to, obviously it's going to base how much they can purchase the house for. It's also a driving force in saying, for a buyer, I may not even want to buy right now, right? So there's a couple, we're going to kind of talk about what some of the experts in the industry are saying as far as what to expect with interest rate, what direction they're going to go. But one factor I want to make sure that we get across is, as interest rates are at a peak level, at least in local time, as interest rates are on the higher end, or what a lot of economics are saying, peak levels, it is the best time to purchase. Okay, I know that's goes against what you may have heard, but it is the best time to purchase because you are going to be at the least amount of competition, right? So if you think the competition is bad now, right? If you are out there right now and you're making offers on houses and it's competitive and there's multiple offers on it, we have story after story on that. Think about what's going to happen if the interest rates were 2 points less. It's going to bring more buyers onto the market. Okay, so something to seriously consider. That or just to make you feel better about the fact that, hey, I am buying right now. My interest rate might be 7%. I am not going to have the 7% rate for forever. Okay, as we refinance, Vinny, UMortgage, we offer great programs for our purchase clients to be able to refinance as the rates go down and be able to do those at like cheap prices. Okay, so something to keep in mind: you're purchasing the house for a long-term investment. And as the market dictates the rates go down, we're going to be able to help you with that.
I'm going to pull out the cheesy quote: marry the house, date the rate.
I knew it was coming.
It's just, like Chad mentioned, the buyers are going to come out of the woodwork when those rates go down 2 percentage points. And is there going to be a higher inventory available? Some experts say no, the inventory might stay the same. So you're going to get a double whammy of, low inventory and now even more competition. And that will probably drive up housing prices even more. So if you do buy that house at the time now, during the summertime, you're in a win because your appreciation is just gonna double because of that demand that's out there in this market.
Yeah. So if you go back one more to the previous slide, just a couple quick points I want to make. Freddie Mac is saying that where the rates are, where inflation are, we should see a gradual decrease in rates from where they're at right now. Mortgage Bankers Association, long-term interest rates have already peaked, which means that they're on their way down. Rates will begin to slide into the summer. So those are some of the you kind of start to see a theme of what the experts are saying. So just something to keep in mind. And then go ahead.
With you experiencing so many presidential elections in your life, have you seen a difference where a difference in rates at that point of a time span too? Like, do you see a difference of rates changing because of politics maybe wanting to jump on something positive in the market?
Absolutely. Not so much of a Republican, Democrat, red, blue, not so much that, but what I will say is it is extremely consistent that there is a lot of rate movement during that election period. And basically, from November election to January, there's a ton of movement in there, which, this, during that time period, there's not typically a lot of economic news. That's usually the slow season for finance.
Yeah.
But that's going to be every 4 years. There's always a lot of movement, even for now. So speaking of rate movement, did you want to add on that?
No,
okay.
I want this because it kind of cones us with, it kind of relates to what these experts are saying as well. That's why it goes hand in hand. It really makes sense.
So local rates, or I should say recent rates, and we're talking the last couple of weeks, we've saw, all the way back from going from May 11th to May 26th. I mean, this is a 2-week period. Rates went.
You would think this was a 2-year span.
Right. Well, it went from literally 6.49 back on May 11th to towards the end of this month we were over 7%, and that's what the two slides kind of represent. I wanted to show you that because there is a high need for buyers to make sure that they're speaking with their loan officers throughout the entire process. I'm not saying daily, but do not be surprised if you don't talk to them in a week. that there could be a lot of movement on your interest rate. And for listing agents that are on the call, this is a call that we will get occasionally where they'll ask, hey, are you sure you went over the rates with this buyer? Because I know they've changed. So, that's something that is extremely important in the process of understanding, what you qualify for, what your payment's going to be, and making sure that you're working with a lender that is fluid in that to be able to kind of give you updates. So speaking of which, that takes us to your trip home. All right, the process of purchasing a house. So, if we want to kind of walk us through, these are going to be the steps we're going to be kind of going through in the process of purchasing a house. And of course, I've already kind of alluded to this. The number one thing you as the buyer needs to do is to get pre-approved. Okay, and it was great. I spoke to a first-time home buyer yesterday. Spoke to her for the first time, and one of the questions I kind of always ask is like, hey, is there any questions that you have right now, just off the top of your head, before I kind of go into, setting expectations? Any questions you have? And basically, why are we talking right now? And the first thing she said was, I know based on the market, I can't go see a house without being pre-approved because, by the time I get pre-approved, that house is going to be off the market. That's exactly right. So, the market's always going to kind of determine how processes change in any industry. And this is one of those changes that, we were just talking to one of our broker partners this morning. They were reminding us that, 20, 30 years ago, the process used to be homeowner goes about figuring out what their payment is themselves without talking to a banker. They get into contract with the real estate agent. And then once they're in contract, the homeowner goes around town and basically shops that loan, okay, or shops that contract. So it's, I would say, the complete opposite right now. So the shopping, the process of figuring out who to work with needs to happen way, way, way up front before you even start viewing houses online, okay? And then once you just kind of determine who you're comfortable working with, we of course want that to be us. But once you have picked your lender, you want to make sure you are 100% pre-approved. Go through that process of being pre-approved and completely understanding what the loan or what loan you're going to qualify for is. So let's talk about the steps that it takes to be pre-approved and what the three pillars are on that. You of course know the three pillars are
credit, income, and assets. Assets, also known as your funds to close.
Yeah. So we'll dive into the first one, credit. Credit is a deep one. It's one that Vinny and I have actually taught classes on for CE. So we could go about 90 minutes to 2 hours on this one. But credit scores go from 350 to 850, and the higher your credit score is, the better your interest rate, the better your terms are going to be, and the more programs you're going to qualify for. So, what are some of the things that you're looking for on an actual credit report besides the actual credit score? I think everybody kind of understands what credit scores look like.
Great question. So the first thing I really try to hone in on is accuracy, making sure that they're aware that these liabilities are on their credit report and that they are theirs, right? So simply put that. And then we look at things being paid on time, the liabilities being paid on time, obviously a big key of where the score is. And another factor that some people really don't realize is the utilization part of how much your credit limit is in comparison to how much you owe on that credit score, on that credit card. So for example, if you have $1,000 credit limit, some people feel like they can max it out each month and just pay little by little. Well, that could have a big damage on the score in comparison to even a late payment on it. So we really dive in on those to try to build the score up as highest as we can, because like Chad mentioned, higher score, better programs, better rates, just an easier, smoother transaction for the client. But we really do a deep dive into the credit, make sure that the client is aware of their score, because we want to have them understand that they're going to dictate where their rate and costs are, because we're going to give them so many options to them.
Yeah, and a great example, this just came up last week, where you're going through the liabilities with the buyer and something comes up, it's a car loan, they may not have mentioned it in the application process, and we're like, hey, this car loan's on there, it's in your name, and it's $500 a month, that's throwing our numbers off. Oh, well, that's my, whatever, my niece's, I got a loan for her, she makes the payments. Okay, so that's something that if we never asked, that payment, that $500 a month, that liability would count against the buyer. Now, that may be something that if they're documented correctly and depending on how long they've been there, we can remove that from their equation, but it may not be. But the key factor is if we're not reviewing the credit report with the client, they're not going to know that, okay? So important, just as important what the score is to know what is showing up on your credit report as far as the payments and overall. So next pillar, income. All right, so income, extremely important, and it's also important, just to take a step back, of the 3 pillars, it's not like a 2 out of 3, 1 out of 3 thing, right? This isn't baseball. We need all 3 of these to get your best loans, okay? So when we're looking at income, okay, we need to make sure that we are looking at the right category for what type of buyer it is, okay? So what I mean by that is, based on how you receive your income. If you're, an employee of a company, you have a salary, you have bonuses. If you own your own business, if you're 1099, if you're a contract employee, if you work at Skyline and you get tips, based on what it is that you do for a living, that's going to really determine what documentation that we're asking for. Okay, so maybe walk us through how you are kind of setting up your clients to have the right expectation on what documentation to prepare for.
So like Chad mentioned, we'll go straight into someone working at Skyline, and I have someone who's actually working at a serving position, and they do receive tips. So typically the items that we're going to ask for, and we'll prepare that on our initial call, is your most recent pay stub, right? We'll show what you've made year to date, and then typically your 2022 year to date, your year-end pay stub, and your 2021 year-end pay stub. Those pay stubs would typically show the totals for your tips and for your salary, etc., which will help us average and maximize the income for the client. This way, it's talked about at day 1, not at day 10, and they're scrambling trying to find their stuff. So we're really trying to be initiative and bringing that stuff up front.
No, and I know cash used to be a lot more common than it is now, but I know when I'm tipping someone, a lot of times I try to do that in cash, try to save them from having to pay taxes on it or what have you. What's the process with that when a server is receiving cash tips?
So 9 times out of 10, the tips are calculated on the pay stubs nowadays with credit card tips. If they're cash tips, then they would have to be filed on the person's tax returns, and then we will collect those tax returns from the client as well. I would say 9 times out of 10, we're seeing just the credit card tips on there.
It's not a lot of honest Abe's on there on the credit on the taxes.
Well, and honestly, I'm guilty too. I do a lot of credit card tips myself, unfortunately.
Yeah. So, and then obviously, if you own your own business, you've got tax returns that look like that, and other types of. But the key factor to remember on this, the takeaway is, whatever your employment is, how you receive your income, that's going to determine what we're asking for. Okay, so if we're asking for documentation, whether it's as simple as a pay stub from last week or a pay stub from 2 years ago, okay, obviously it's okay to ask, how am I supposed to get that? And we will walk you through options on being able to get things that you may not have access in your pocket. But just remember what we're asking for. There's a reason behind that. So if you have questions, if you're wondering why that's important or why we would need that, or hey, you're asking for this, I've already given it to you. Those are great questions to ask, and there's always an answer for it, and it's always really. We're never asking for something that we don't need, and the underwriter's not going to ask for, right?
Believe us, yes.
Yeah, we don't want to collect any more than we have to either, right? So
and then the opposite to that, we're going to get creative in trying to find income for you as well. If we're seeing a lot now with housing pricing increasing and clients and borrowers not wanting to let go of that low interest rate,
yeah.
they're keeping their primary residence, and we're able to turn that into new income for them, right? So with the knowledge that we have, we're able to, and what I mean by being creative, by knowing the guidelines, right? Knowing where we can use income, where we can, to help that client find their next home. So we're going to dig deep into the guidelines and into what the client has to offer to try to build more income if needed.
Yeah. So, now moving on to assets or cash to close, just like with income, just like with every buyer, every single situation is a little bit unique. Okay. So the cash to close, just to kind of define it, it is your cost and your down payment combined. It is the actual money that you're bringing to the closing, hence cash to close. That is basically you're out of pocket for to purchase the house. Okay, we like to combine both of them so that you're not fixated on a 5% down or 15,000 down. We want you to focus on how much the total is, because that's what's important to you as a client. We're of course going to itemize each one of those costs all the way down to the credit report being $37, right? But the key factor is and you're educated in exactly how much everything is. But like you were saying about the income, okay, being creative on how to get the most down payment to maximize the best loan or the top end of what someone can buy. Now keep in mind also, I think it's important to understand, like, we're not trying to get people approved for houses that they can't qualify for. A lot of people, let's say it's a Mr. and Mrs. buying a house, okay? Well, Mrs. credit score is a 750, Mr's is a 650, because of course, guys are unresponsible and they have a lower credit score. So Mrs. Makes X amount of money, Mr. makes X amount of money. We're trying to qualify the combined couple with just one income because she has a better credit score. So that's a really good example of where we would be maxing out what they qualify for, but not really, because we're not using all the income in the household.
Exactly. So sometimes we'll look at a couple who maybe has a fund that's set up, and maybe we can use that as a distribution to gain additional income. Or if someone has a 401k that they're eligible to use for down payment to help with their debt to income ratio and maybe pay off some debt, right? Maybe we can get rid of something that has a high payment, and in reference to putting more money down, it maybe makes more sense to pay off a liability to help with that debt to income ratio.
Yeah. So, takeaways for you, the buyers, always just fully disclose everything. If you kind of touched on, if you have a trust account that you don't touch, or an IRA that you don't want to use as part of the loan program, make sure that you're listing everything to us when we're asking those questions, because it's best to have all the information, because there may be a way that we can use your IRA that you're not receiving income on right now and use it as an actual income, even though it's an asset. So tricky stuff, but just keep in mind, just fully divulge all of your information so that we, the experts, can put a great loan program together for you.
And if you're pre-approved with us, or going through the pre-approval process, our application with Arrive kind of, I wouldn't say pushes that, but definitely incentivize for asking for those additional documents so that we can get the best pre-approval for you possible.
Yeah, so here's an example of a buyer who's pre-approved, okay? They came to us with a certain, what they wanted to do. And here's an example of us showing 2 of the actual 4 options that we showed them. This screen can only show 2 at a time, but this is just an example of, hey, this is a buyer that, we have a purchase price, $300,000. We're going to show 2 different interest rates with 2 different cost structures, which bring 2 different cash to closes and 2 different monthly payments. So I always say, if you take a buyer and you show them all the options, one of the 3, interest rate, payment, or cash to close, are going to stick out to them, and it's going to be easy for us to put them into the right loan. So the process that we use is to make sure that we're showing the options and we're making it very clear to them, what all of their options are once we have them pre-approved, so then that they know, hey, this is why I'm not doing FHA. This is why I'm putting 5% down versus 15% down. It's their decision. We're happy to give them any of the loans they qualify for, as long as they know all of their options.
Exactly. This is the process that we typically do when someone's in contract and we want to disclose their loan, and we want to give them the option of hey, you're going to be making the payments for the next 5, 10 years or so. You choose what you want. What resonates to you? Is it the funds to close, or is it that monthly payment? And sometimes during that inspection period, it really helps out. Okay, hey, we need to save that $1,500 because we have to buy a refrigerator or something like that. So giving our clients the option is really something that we feel like we distinguish ourselves and separate ourselves from.
Yep. Okay, so 3 pillars: credit, income, assets. Now you're pre-approved. You're fully educated because you went through your consult with us. We went over your options. You've picked, a couple of your different options of what you want to do. Now you're in the process of looking at houses, okay? And there are, things that you want to, I guess, look out for, be aware of, and understand. And, I guess just from 50,000 feet away, just understand, hey, we have qualified you off of your information from today. So anything that changes your information today, purchasing a new house, quitting your job, all of those different life factors, as small as taking out a new credit card, are going to change your qualifications. It's not to say that it will immediately turn you down or make you ineligible to purchase. It just changed it, okay? So maybe talk a little bit about the list that everybody is seeing right now between the do's and don'ts.
Yeah, really quick, obviously you've already came to this point and your records have been in order. So just make sure that you keep your passwords typically, right? Everything is password protected nowadays. So make sure you have your passwords, where your previous W-2s or previous tax returns are, and also make sure that you are keeping that credit rating. You're not thinking about, okay, we have to go buy appliances for a house that we don't even have yet. Always consult us before that. And then obviously one of our big ones is make sure you work with a trusted real estate partner, especially in this market. You're definitely going to need someone to quote unquote handhold you throughout this process for sure. One of the biggest don'ts is like I kind of mentioned before is, if you see something that you truly need and truly have to put it on credit, definitely consult with us beforehand. Changing jobs with a new company, sometimes that's dicey. If it's something that it's for the better, we're obviously wanting our clients to better themselves. So we always just want to consult that with you. And then a big thing is undocumented deposits, right? So if it's not from your pay, if it's not from maybe a check or something from a family member like that, if it's cash, definitely consult with us beforehand, because that's where it could get a little dicey on sourcing the funds, okay? Because the majority of your down payment needs to be sourced from a specific spot of where the down payment's coming from, whether it's savings or 401k, kind of like we mentioned in the asset section.
Yeah, when we say consult with us about a job change, it's not like we're going to sit down with you and tell you to not take a job, right? Everybody's going to do what's best for them, but it's good for you to know, hey, for you to take this job, it's going to put you 1 year to 2 years out from purchasing a house. Okay, it's better to know that before you're in contract than a week before closing. Okay, that's what's right for the seller in their involvement in it, and what's right for you to know as well. So going back to just the transparency of what your game plan is in life, that's what's key to helping this process. So when you're making an offer, you get to the point where you found a house, you want to make that offer. This is where it is probably the most important step right now, especially in this market. We spend a lot of time at the beginning of this class talking about what's happening with the market, right? It's a seller's market, and what that just basically means is there's a lot of buyers going after one house. Okay, perfect example. This morning, talking to a listing agent. She's like, hey, there were 15 offers on this house that your client made an offer on. You're in the top 4. Okay, tell me why I should pick yours. right? So these are the conversations that we're having on a regular basis, okay? So I want to make it clear, okay? It is a market where it is challenging to get your offer accepted. Vinny, last month, be the first to tell him, congratulations on your record-breaking month, your top month ever, okay? And that happened in this market. So obviously, you're the expert right now on telling us, how are you getting your buyers' offers accepted at such a high rate? A record month in this type of seller's market, how are you getting them to say yes to the offers that you're making?
Well, there's our cheat sheet right there. So number one, we have our buyers prepared, right? That whole 30 minutes that we just talked about, our buyers are super educated and prepared. They know their numbers. They know their terms that they're able to go with. So I have that in my back pocket, and I call the listing agent at the time of offer, right? We have the strongest buyer possible, and we're gonna tell that listing agent about that. I'm gonna ask the listing agent some questions that maybe our buying agent might not know to ask or feels comfortable to ask, and we're gonna ask those questions. What's it going to take for us to get in here? You know, what can we maneuver? What can we figure out to try to get this to happen? Is it a delayed occupancy, right? Does your seller need 15, 20, 60 days to stay in the property after we buy it in 2 weeks, okay? My buyer can do a gap appraisal. Just talking with a great buyer yesterday. Brian is able to do a gap appraisal. He's a unicorn. He's got no contingency. He can do a delayed occupancy, and he has a gap appraisal. So that's a huge tactic for a buyer, because what a gap appraisal means is if someone goes to offer 400,000, say, and the property appraises for 390, well, we have a gap appraisal in there for $10,000. Well, that seller is still going to get their money for the $400,000. And the way that we can structure these loans for our buyers is it's not going to cost our buyer any difference monthly payment-wise or out-of-pocket expense, right? We don't want to have our clients be more out-of-pocket just to get the house of their dreams. We want to make sure that it makes sense and that it's still the terms that our buyer wants. Fast close, we're able to close loans in 8 days. The compliance, the quickest that you're allowed to close a loan is 8 days, and we're able to do that, whether we need an appraisal or we don't. We have one of the 2 top processors in our company here, Lauren and Nick. They're literally here in our office. We do a lot of stuff here in the office. So that's how we're able to do loans very quickly. And then a bridge loan we haven't really talked about much. If someone owns a property currently, we're able to tap into that equity, right? Because equity in current housing right now is gone beyond what it's been ever. So there's a ton of equity, and what a bridge loan is using the equity from an existing home for down payment on a new home. To sum it up, is we're calling the listing agent, we're getting that buyer's name out there, and hopefully on the top of the list to get accepted.
Yeah. So, I mean, I would add to that, it's great because we have been in this local market for so long. We know a majority of the listing agents.
Local.
Okay?
Yeah, that's a good point.
And they know that what they're going to get from working with us because they've worked with us in the past. You know, you had mentioned fast closings. Our average app to CTC as a branch is 13 days. Okay. You had one that was 2 days last week. 2 days, the loan was apt, clear to close, 48 hours, okay? I'm telling you, if you're not in this industry, it may not mean much. That is huge, okay? So when we are offering all these things to the seller, keep in mind, none of the things on that list are to be the top price, okay? So we're not in this to get you to spend more money to get the house, right? That's easy, right? We're in this to put a very reasonable, good offer in, right? And then on top of that, add a bunch of non-monetary items that are going to make the seller take our offer and slide it in front of them, okay? So these are the things that are going to be the difference between you getting a house and you not getting a house, okay? So folks that missed out 2 years ago, missed out on, 18 total percent in appreciation, okay? So what we're trying to get is that you get in your house as soon as possible so that you can start living that American dream and getting that appreciation. So that's the key factor. And remember, as the rates come down, which we know they're going to, all the experts said, the rates are going to come down. It's going to become more competitive. That's good if you've got your house. more competitive means the prices are going to go up. You're going to be able to realize that. Bad if you miss out when more competition comes because you're a part of the competition, right? But we'll be ready for that regardless of that. So, all right. So now that you're in contract, we're going to talk quickly. Just what is the process when you're in contract? What the buyer should expect.
We like to do a lot of hand holding. There's a lot of steps when you're purchasing a house. So everything that we do is digital. It's all e-signing, the loan documents, compliant, secure. It's all e-signing. You'll get a video from our processor for the next steps of what goes on. So a real hands-on approach, a real personal approach to getting us to the finish line. We'll set you up for underwriting, talk about, make sure that everything does stay the same, kind of like Chad said, did anything change from day one to where we are now. And then we'll just get you that roadmap to closing. We really try not to complicate all that much because as you can see in the pre-approval process that our clients on here can probably vouch for, we do a lot of the heavy lifting up front so that when we get to this contract and processing part, it's smooth sales. We can close in that very quick timeline. National average, I read it yesterday, national average, UWM mentioned, was 43 days from signing to close. We're at less than 13 days. We're at like 12.9 or something like that. 43 days. So like Chad mentioned, the terms of the contract that we're trying to negotiate, not just blow out a purchase price, the terms are what matter. So that's what we're trying to separate from other buyers.
That's right. So, and obviously once we get to the closing, we're going to have happy buyers. Happy buyers yield happy testimonials, happy surveys. We actually lead our market on what's called the Net Promoter. I never get this right. NPS.
We're really good.
Yeah,
we promise.
We're super good. So our score is 95. This is a survey that all of our buyers after closing, after all the dust settles and they're moved in. Okay, how did we actually do? Right? Not in the process, right? And we even count the bad ones, right? So our total score is 95. And that is because of all the steps of the process. Now, part of the process if you're on this call, you were referred by someone that either cares about you or that you're working with as a realtor, and hopefully it's both, right? And I told you at the beginning of the call, we're going to ask for your help. So our ask to you is if you've had value or if you receive value from this, we're going to ask that you give us a name and a phone number of someone that you care about, that maybe they're renting right now, or maybe they're a homeowner right now, someone that we can talk to, just like we've talked to you, and be able to help get them into a home when they're ready for it, okay? And above and beyond anything, just kind of show options, give them some education on what's going on with the market. But anybody that that is similar to you, that we can help them. And we'd ask for you to fill that out on your survey, part of your survey. Once you complete that, you will receive your $300 off your closing, a credit for $300 on your closing. And that will conclude the class. And I really appreciate everybody that was on here. We went a little bit over on time, so hopefully everybody's still on. But we really appreciate everybody showing up today. So if you have any questions, please reach out to my man, Vincent Derisi, or myself. We can definitely help you with anything that you need. Beyond that, have a great day. Appreciate everybody.